The biggest mistakes in markets do not happen because people are stupid. They happen because people keep using the wrong lens. They look at a falling price and assume value is collapsing. They look at a rising price and assume strength is building. They look at a chart and think they are looking at a business, a reserve asset, a monetary system, a war, a funding shortage, and a political crisis all at once. They are not. They are looking at the final print. I have spent most of my life learning a simple lesson that almost nobody wants to hear when money is on the line. Price is often the loudest thing in the room and the least intelligent thing to follow. That is especially true in gold. When most people see gold falling, they immediately reach for the most comfortable explanation. Traders are rotating out, momentum broke. The chart looks weak, the move is over. Those explanations are not always wrong. They are just usually too small. They describe the screen. They do not describe the machine. And if you do not understand the machine, you will keep doing what small investors do in every era. You will mistake liquidation for invalidation. You will confuse a forced seller with a change thesis. You will see pressure and call it truth. That is how people sell the best assets at the worst moments. So let me tell you the way I would think about what is happening in gold right now if I were sitting across the table from you and you asked me whether this decline means the long bull market is broken. My answer would be direct, no. Not because price cannot fall further. It can. Not because the decline is harmless. It is not. And not because every seller is wrong. Some of them will sell for perfectly good reasons. My answer is no, because I do not think this is primarily a story about lost conviction. I think it is a story about pressure. Pressure is the master line. If you understand where the pressure begins, how it travels, who it reaches first, who is forced to respond, and what happens when that pressure finally exhausts itself, the whole market changes shape in front of you. Then you stop reading gold like a headline. You start reading it like a system. And once you do that, you realize something that most people only understand after they have already made the expensive mistake. The most important move in a bull market is often the reset that terrifies the last weak holders out of it. That is where I want to start. Gold is not behaving like a simple commodity here. It is behaving like a reserve asset inside a pressure system. That distinction matters. If this were merely a story about jewelry demand, seasonal positioning, or the latest macro trade on a New York desk, I would not find it especially interesting. But that is not what I think we are looking at. We are looking at a chain reaction running from war to energy to dollars to currencies to central bank balance sheets to reserve liquidation. Most people never follow the chain that far. They stop at the price. That is why they arrive late, leave early, and never understand why the people with the greatest patience keep buying what everyone else is desperate to throw away. I want you to imagine a series of pipes inside a building. At the top of the building, something ruptures. Down below, water starts flooding rooms. If you only stand in the lobby and watch the water rise, you will say the lobby is the problem. It is not. The pressure began elsewhere. The flooding is just where it became visible. That is how I think about this gold decline. The visible price weakness is the lobby flood. The pressure began much higher up the system. The first mechanism is what I would call the dollar choke. When a country imports energy, it does not get to settle those bills in its own self-esteem. It pays in dollars when oil surges in the middle of a geopolitical shock. That country does not merely face a higher invoice. It faces a funding emergency. Now take a country like Turkey, which relies heavily on imported oil and natural gas. If war erupts nearby and energy prices lurch upward, the problem is not theoretical. It lands immediately on the national balance sheet. Contracts still need to be honored. Energy still needs to arrive. Dollars still need to be found. If the local currency is already fragile, that fragility suddenly becomes a full public event. Once the domestic currency starts breaking lower, every choice becomes painful. Let it collapse. And inflation accelerates into political danger. Spend dollar reserves and you burn down the buffer you were already short of. Sell reserve assets, and you buy time at the cost of future optionality. At that point, gold stops being a symbol of prudence and becomes a source of emergency funding. That is what ordinary investors miss. They hear that a central bank sold gold and assume the central bank lost faith in gold. That is the language of people who have never been cornered. When pressure is severe enough, intelligent institutions do not sell what they dislike. They sell what they can. That is not the same thing. I have seen this mistake in stocks, in bonds, in private businesses, and in insurance markets. When someone is under pressure, they rarely liquidate the weakest thing first. They liquidate the liquid thing first. They sell the thing that can raise cash today. Gold is highly liquid. That makes it useful. It also makes it vulnerable during a squeeze. So when I hear that Turkey sold or swapped roughly 60 tons of gold in a compressed window after the regional war shock, I do not hear a philosophical statement about gold, and reserves become the oxygen tank. Now the second mechanism is the reserve spill. This is where investors get badly fooled, because they keep thinking about one country at a time. Markets do not care about your preference for clean, isolated stories. When one central bank is forced into the market, it matters. When several official sector participants either sell, pause, or consider monetizing reserves in the same broad window, it changes the character of the entire tape. You have to ask a different question, not who likes gold, who needs cash. That is the adult question. A bull market can survive disbelief. It can survive skepticism. It can survive boredom. What it cannot glide through cleanly is a wave of reserve holders turning into temporary suppliers for reasons that have nothing to do with long-term conviction. That is when you get the spill. One country sells to defend a currency. Another sells to finance wartime strain. Another pauses buying because domestic liquidity now matters more than strategic accumulation this quarter. Another debates whether reserves should be monetized for defense expenditures. Viewed individually, each case sounds special. Viewed together, they become a supply event, and supply events terrify retail holders, because retail holders always imagine intention where there is only constraint. They tell themselves a story like this: if the biggest buyers are selling, the thesis must be broken. That sounds intelligent. It even feels disciplined. But it is still lazy thinking. If the biggest buyers are selling because they need to survive a funding shock, that tells you almost nothing about what they will do when the shock passes. That is the point most people cannot hold in their minds because they want a single clean answer: bullish or bearish, good or bad, buy or sell. Markets are not that polite. You can have near-term selling from long-term believers. You can have temporary liquidation inside a structural accumulation era. You can have a bull market whose most violent downward phases are created by the very institutions that later rebuild the trend. That is not contradiction. That is how pressure systems behave. The reserve spill takes what began as a local funding stress and turns it into broader market supply. Once that happens, price weakness starts attracting the wrong kind of commentary. People stop asking who is under pressure and start declaring that the whole idea has failed. That is exactly when third-rate thinking becomes most expensive. The third mechanism is what I would call the memory of sovereignty. This is where I think the long game still lives. There are moments in monetary history when governments quietly relearn the same lesson. They do not trust abstractions, they trust what cannot be frozen, diluted, or politically redefined overnight. If your reserves sit inside a structure someone else can immobilize, then in a real dispute, those reserves may turn out to be accounting comfort instead of actual sovereignty. Policymakers all over the world noticed that lesson very clearly when reserve assets became subject to geopolitical force. Once a country understands that an asset with counterparty risk is not the same as an asset it can truly command in a crisis, that understanding does not disappear because the price wobbles for a quarter. That is what I mean by the memory of sovereignty. It is not a trade, it is a scar. Scars change behavior for a very long time. That same central bank may still prefer gold over foreign paper the moment the emergency fades because the strategic logic did not change. The timing changed, the pressure changed, the immediate need changed, the memory did not. This is the difference between a cyclical transaction and a structural preference. People confuse them constantly. They see sales and call them ideological. They see pauses and call them permanent. They see a quarter of stress and assume a decade of behavior has been overturned. I do not invest that way. I do not think that way in insurance. I do not think that way in equities. And I would not think that way here. When a nation discovers that gold is clumsy, expensive, politically inconvenient, and still uniquely free of counterparty risk, that nation has not stopped valuing gold simply because it sold some to navigate a war shock. It has just moved from owner to forced seller for a season. That season matters. But it does not settle the argument. The fourth mechanism is the liquidation echo. This is where the real pain enters because official selling does not remain official for long. It moves outward, it reaches weaker hands, it infects interpretation. Gold falls. People who never understood what drove the bull market in the first place decide they suddenly understand why it is over. That is almost always a bad sign. Retail investors have a talent for turning somebody else's forced action into their own emotional conclusion. They watch a decline that began in balance sheet necessity, and they finish it with psychological surrender. That is the echo. First, the pressured institutions sell. Then the chart deteriorates. Then the commentators simplify the story. Then the weak holders accept the simplified story. Then they sell too. Now the decline has new fuel. This part matters because it is the phase that creates the deepest discounts, not the first official sale, the emotional echo that follows it. I have watched some version of this pattern again and again. It is never announced cleanly. Nobody rings a bell and says the market has now moved from structural selling to emotional selling, but you can feel the quality of the narrative change. Early on, the market is being hit by obligations. Later, it is being hit by interpretation. The obligations are finite. The interpretation can overshoot. That overshoot is where opportunity is usually born. The market always finds a way to hand good assets from impatient owners to patient ones. That transfer is rarely comfortable. Now, I want to tell you why I think this particular reset matters more than the ordinary investor understands. It is not enough to say gold had a large run and now it is correcting. That sentence is too small for the world we are living in. We are no longer in a monetary environment where sovereign balance sheets, reserve choices, sanctions risk, energy vulnerability, and global fiscal strain can be treated like side notes. They are the center of the stage. When I look backward several decades, I do not simply see previous gold resets as isolated price episodes. I see them as stress tests, revealing how monetary systems behave when confidence, liquidity, and political order stop cooperating. In earlier eras, public debt burdens were smaller. Official accumulation frameworks were shallower. Reserve diversification was less urgent. The global recognition of sanction risk was less explicit. The infrastructure around strategic sovereign gold accumulation was nothing like what it has become. Today, the scale is different. The incentives are different, the fragility is different, and the long-term appetite for reserve assets without counterparty risk is different. That does not mean price goes straight up. It means the underlying reasons nations want gold today are more deeply embedded than they were in many earlier cycles. That is why I do not look at this decline and conclude the destination has changed. I conclude the rout has become violent. There is a difference. A businessman learns early that a superior enterprise can still go through ugly quarters. The quarter does not define the enterprise. The capital structure, the competitive position, the resilience of demand, and the intelligence of management define the enterprise. Apply the same mental discipline here. If the strategic case for gold is rooted in reserve independence, geopolitical fragmentation, fiscal excess, and distrust of purely financial claims, then a wave of forced selling caused by wartime dollar demand does not erase that case. It interrupts it. It cheapens it. It tests your ability to distinguish signal from pressure. Most people fail that test because they are raised on commentary instead of process. So let me give you the process. When I study a situation like this, I do not begin by asking whether the chart is attractive. I ask which pressure is primary, which pressure is secondary, how much of the current move is voluntary, what would have to change for the pressure to ease, and whether the actors involved are behaving against preference or in line with preference. That process immediately puts you ahead of almost everybody using social media as their macro department. If a central bank that spent years accumulating gold becomes a seller because war has changed its dollar funding needs, then the sale belongs in the category of distressed adaptation, not strategic abandonment. That classification matters because distressed adaptation tends to be finite. No country can liquidate reserves forever. No emergency sale continues without limit. No crisis driver remains equally intense indefinitely. Everything in markets that comes from pressure contains the seed of its own exhaustion. That does not tell you the exact bottom. It tells you what kind of event you are in. And that is often enough to save you from becoming your own worst enemy. Now, let me translate all of this into a sequence you can actually hold on to when prices are moving hard and everyone around you is trying to replace thought with adrenaline. I would think of the path here in 3 phases. The first is the forced liquidation phase. That is where the market is dominated by the immediate needs of sellers who are not optimizing returns. They are meeting obligations, defending currencies, financing state strain, preparing for restrictions, or preserving near-term functionality. In this phase, price can go lower than rational people expect, because rational people still underestimate how much supply distress can produce before it burns out. A forced seller does not care whether you think the asset is undervalued. A forced seller cares about cash. That is why this phase is treacherous for anyone who has never studied distress. Cheap things can become cheaper for reasons that have nothing to do with long-term value. The second is the stabilization phase. This is the phase where the pressure no longer intensifies. It does not even need to disappear. It just needs to stop worsening. Maybe oil stops climbing. Maybe shipping routes partially normalize. Maybe a currency stops making fresh lows every few days. Maybe the panic around financing needs begins to settle into something manageable. This is where markets start testing for floor instead of freefall. People waiting for perfect clarity will still feel uncomfortable here, because stabilization never arrives with the certainty of hindsight. It arrives as a loss of momentum in the pressure system. The third is the structural reentry phase. This is where the strongest buyers return, not because the headlines are clean, but because the reasons they wanted the asset before the crisis are still present, and the price has been marked down by forced supply. This is the phase people always wish they were prepared for and almost never are, because they spent the reset telling themselves the entire thesis had died. That is how expensive narrative weakness can be. You do not need to predict the exact day Phase 2 begins in order to understand that Phase 1 is not the final verdict on Phase 3. You only need enough discipline to stop treating every liquidation print as a referendum on long-term value. I want to say something here that many investors need to hear, even if they do not like hearing it. Patience is not the same thing as passivity. A lot of people think being patient simply means sitting there and suffering. That is not how I define it. Patience is the ability to let a process reveal itself without volunteering your capital to ignorance. In a reset like this, patience has structure. You watch the pressure points. You watch the currency under siege. You watch the energy variable that is feeding the dollar squeeze. You watch whether confirmed official selling is still expanding or beginning to plateau. You watch whether rumor is doing more work than actual supply. You watch whether the actors involved are sellers by philosophy or sellers by necessity. That is patient intelligence. Most people skip all of that and settle for mood. Mood is a terrible analyst. Now, because I have spent my life allocating capital rather than decorating opinions, I also care about the boundary between a good thesis and a survivable process. That is where many people blow themselves up even when they are directionally right. They hear an argument like this and immediately decide the correction must be the opportunity of a lifetime. Then they bet like a man trying to correct his childhood in one afternoon. That is not investing. That is confession. No matter how strong the structural case is, if the market is still in forced liquidation, you do not get paid extra for recklessness. You get punished for it. I would much rather own a little of a good idea with durability than too much of a good idea with no room to think. That principle has protected me in more than one arena. If you are dealing with a pressure system, you respect the fact that price can overshoot before it recovers. You keep enough liquidity, enough emotional distance, and enough humility to survive being early. There is no medal for being the first person to declare the bottom. There is only the possibility of becoming another source of supply when the market gets meaner than you expected. That brings me to the identity flip that matters most here. Most people come into markets as price readers. They think their job is to interpret movement. That identity guarantees emotional instability because movement is the one thing the market produces in unlimited volume. I want you to become a pressure reader instead. A pressure reader asks different questions. Who is trapped? Who is funded? Who is defending? Who is liquidating? Who is waiting? Who is returning? Once you shift from price reader to pressure reader, a falling market stops feeling like a personal insult and starts feeling like evidence moving through a system. That change in identity is worth a fortune because it reduces the impulse to join everybody else's emotional timing errors. The crowd almost always buys when the narrative is easiest to repeat and sells when the narrative is easiest to fear. A pressure reader understands that the easiest narrative is often the most expensive one to act on. Now let me make this concrete in the way I would want it made concrete if I were trusting somebody else with my attention. If I were building a working operating system for thinking through this gold reset, it would look something like this. First, I would separate strategic conviction from tactical timing. Strategic conviction answers one question. Do I believe the long-term reasons official and private actors want gold remain intact? Tactical timing answers another. Is the market still being hit by active force supply that can drive price below where my instincts want to call it cheap? Those are different questions. Blending them is how people lose discipline. Second, I would track only the variables that belong to the pressure system. not the noise of every commentator, not the daily emotional weather. I would watch the currency under stress that is driving reserve sales. I would watch energy prices because they are feeding the dollar need. I would watch whether shipping or geopolitical disruptions are easing. I would watch whether confirmed official sector actions are expanding or becoming old news. I would watch whether the most stressed sellers are nearing a constraint. That is enough. You do not need 50 indicators when 3 real pressures are moving the whole system. Third, I would preserve optionality. When a market is resetting through liquidation, optionality is precious. Cash is not cowardice. Patience is not ignorance. The ability to act later without being forced to act now is a tremendous advantage. People throw that away because they are ashamed of not looking decisive. I have never found shame to be a particularly useful valuation tool. Fourth, I would scale thought before I scaled size. In other words, I would increase exposure only as the evidence of stabilization improves, not because my ego has become attached to a clever thesis. This is where grown-up investing separates itself from cinematic investing. The movies always reward the heroic all. In Call, real life often rewards the person who stayed solvent, stayed observant, and kept adding only when the machine started to ease. Fifth, I would remember what exactly creates the biggest opportunities in reserve assets. It is not comfort, it is not applause, it is not the chart everybody wants to buy. It is the period when a structural asset is being sold by actors who do not want to sell but need to. That is the gift hidden inside the unpleasantness. You are not being invited to love the discomfort. You are being invited to understand it. Let me say a word about the temptation to turn this into a simple target game. People love targets because targets let them outsource thinking. Someone says 6,300 by year end. Someone else says 8,000 in an upside case. And now the conversation becomes a contest in numerical confidence. I understand why that is attractive. It gives the illusion of precision. But I do not want you to become a target worshiper. Targets are less useful than mechanism. If you understand the mechanism, you can live through target changes without losing your mind. If all you own is somebody else's target, every downtick feels like betrayal. The structural case for higher gold over time may be sound. That does not mean the path will be polite. And if you cannot endure an impolite path, then you do not really own the thesis. You are renting the mood. A rented mood gets canceled quickly. A real thesis survives discomfort because it was built on cause and effect, not borrowed excitement. Now I want to address the most dangerous psychological error in moments like this. People assume that because they finally understand the story, they are entitled to the payoff. No, understanding improves your odds of behaving intelligently. It does not exempt you from volatility. The market still reserves the right to embarrass the informed. That is why process matters more than emotional certainty. If your process is sound, a further decline does not destroy you. It educates you. It gives you room. It lets you act from strength rather than panic. If your process is unsound, even a correct long-term thesis can ruin you in the short run because you positioned like a prophet instead of a capitalist. I never liked prophets as investment partners. Capital allocators should care about sequence, endurance, and the price of staying in the game. That is why I keep returning to pressure. Pressure tells you what kind of sellers you are facing. Pressure tells you whether a move is broad conviction or stressed necessity. Pressure tells you whether a falling price should be treated like warning, noise, or developing opportunity. That framework will serve you far longer than any dramatic one-line prediction. You should also understand that the very features which make gold strategically attractive to nations are the same features that make its resets violent. Because it is liquid, it can be sold. Because it is trusted, it can raise cash. Because it is politically unencumbered relative to some other reserve forms, it can become the thing sold to defend whatever must be defended first. Paradox is built into the asset. Its usefulness creates its vulnerability during stress. Its strategic desirability creates the conditions for temporary strategic looking weakness when survival needs rise. That is not a flaw in the thesis. That is part of the thesis. If you understand that, you stop being shocked by resets and start asking whether the reasons for ownership remain larger than the reasons for liquidation. I believe that is the right question, not whether the current move feels scary, not whether television can explain it in a sentence, whether the reasons for ownership remain larger than the reasons for liquidation. In my judgment, they do. That does not tell you to abandon discipline. It tells you not to abandon intelligence. There is a difference. The final mechanism is what I would call the return of strategic hunger. Markets always underestimate how quickly forced sellers can become future buyers once a crisis passes. Human beings have a habit of assuming the latest action expresses permanent preference. It usually does not. It often expresses immediate constraint. Once the pressure system cools, the same countries that learn painful lessons about currency vulnerability, sanction risk, reserve fragility, and geopolitical exposure are unlikely to decide they now prefer dependence. They may buy slower, they may buy later, they may buy in a less visible way, but if the logic of reserve diversification remains alive, strategic hunger returns. And when it returns after a reset, it does not return to the old price. It returns to a market already scoured by liquidation. That is why the strongest moves are often born from the ugliest setups. You do not need to romanticize that. You just need to recognize it before the crowd does. I have spent enough time around markets to know that the crowd loves stories with clean villains and clean endings. This is not one of those stories. This is a story about a reserve asset being dragged through a geopolitical pressure system, repriced by forced sellers, misread by weak holders, and eventually rediscovered by the same strategic logic that fueled the larger move in the first place. That is a much more complicated story. It is also much closer to the truth. If you insist on reducing it to a chart pattern, you will behave like everybody else. If you reduce it to ideology, you will behave like a zealot. If you reduce it to targets, you will behave like a gambler. I would rather you behave like an owner of capital. Owners of capital do not panic when a great business reports a difficult quarter if the reason for ownership remains intact. Owners of capital do not confuse a forced divestiture with a broken industry. Owners of capital do not replace process with excitement simply because the tape is dramatic. And owners of capital know that sometimes the most important thing happening in a market is invisible to the people staring hardest at the price. That is what I think is true here. You are not looking at a simple rejection of gold. You are looking at a pressure event. The pressure event may continue a bit longer. It may get more unpleasant before it gets better. There may be more liquidation, more fearful commentary, more speculation masquerading as certainty, more people declaring the trend dead because they cannot imagine a temporary sale inside a lasting structural demand story. Let them. The market does not pay you for participating in their emotional consensus. It pays you for staying rational when the mechanism is still doing its work. So if I had to leave you with a single framework, it would be this. Do not ask whether gold is merely down. Ask who is being squeezed. Do not ask whether central banks sold. Ask why they sold. Do not ask whether the chart looks damaged. Ask whether the strategic logic has changed or whether the pressure system is simply forcing temporary behavior from long-term believers. And do not ask whether you can look clever by catching the exact turn. Ask whether you can remain patient enough, liquid enough, and disciplined enough to recognize the difference between forced liquidation and genuine invalidation. That difference is where the money usually is. It is also where character shows up. A lot of people think investing is mostly about intelligence. It is not. It is about being able to keep the right model in your head while everybody else is getting paid to simplify the wrong one. Right now, the wrong model is easy to repeat. Gold fell. Therefore, gold failed. That is the child's version. The adult version is harder. A war shock tightened the dollar channel. Energy pressure strained importers. Fragile currencies demanded defense. Reserve assets became funding tools. Official sales triggered price weakness. Price weakness triggered emotional surrender. Emotional surrender amplified the reset. The strategic need for gold did not disappear. It was temporarily subordinated to survival. That is the model I would use. And if that model is even broadly right, then the final question is not whether the reset feels bad. Of course it feels bad. The final question is whether you want to behave like the person who mistakes the pressure system for the destination or the person who understands that the pressure system is often what gives you access to the destination at a better price. Those are two different lives. One belongs to the reactive investor who keeps buying clarity and selling discomfort. The other belongs to the patient allocator who understands that the market often hides its best long-term opportunities inside the ugliest short-term funding events. You do not get to avoid choosing between those two identities. Every reset makes the choice for you if you will not make it for yourself. And the cost of choosing badly is not just a bad trade. It is spending your financial life reacting to pressure you never bothered to understand. That is a very expensive way to live. So here is the real test. When a reserve asset is being sold by institutions under visible strain, when the commentary grows louder than the mechanism, when weak hands start confusing forced liquidation with broken value, and when the market is trying to scare every impatient owner into surrender, will you join the liquidation echo and call it wisdom, or will you keep enough discipline to read the pressure system properly and wait for strategic hunger to return? That is the threshold. That is the contract with your future self. And once you see the market that way, you cannot honestly go back to pretending the chart was the whole story.